Today's market moves weren't just a continuation of yesterday's rally. They reflected a meaningful shift in how investors are weighing geopolitical risk against economic resilience. U.S. equities extended their gains, but at a more measured pace. The Nasdaq led higher, followed by the S&P 500 and the Dow. At the same time, bond yields edged slightly higher, suggesting that optimism around growth is being balanced against a still restrictive rate environment. But the more interesting story was in commodities. Oil fell sharply for a second straight session, while gold moved in the opposite direction, rising to new highs. Volatility continued to compress, and the dollar remained relatively stable. So on the surface, this looked like a classic risk-on day, but underneath, the drivers were more nuanced. What changed wasn't just pricing, it was expectations. The first major shift came from geopolitics. Signals of de-escalation in the Middle East, including progress toward reopening key shipping routes, reduced the immediate risk of a prolonged supply shock. Markets began to move away from a worst-case scenario of sustained disruption toward a more manageable normalization. At the same time, economic data added a second layer to that narrative. U.S. manufacturing unexpectedly moved back into expansion territory. That's important because it challenges the idea that the economy is slowing meaningfully under higher rates. Instead, investors are now considering a different possibility, that growth may be stabilizing or even re-accelerating despite restrictive policy. And then there's the policy backdrop. The Federal Reserve continues to signal patience. Markets are increasingly interpreting this as a willingness to tolerate short-term volatility and inflation rather than reacting aggressively to it. So when you put these together, easing geopolitical risk, resilient economic data, and a steady central bank, you get a shift in the baseline narrative, from fear of disruption toward cautious optimism about stability. That shift is clearly visible in how capital moved today. Institutional money rotated decisively out of defensive positions. Energy, which had been a key inflation hedge, saw heavy selling as oil prices dropped. Defensive sectors like consumer staples also lagged. At the same time, capital flowed into technology, industrials, and consumer discretionary, areas that benefit from lower input costs and stable growth expectations. Technology leadership is particularly telling. Investors are favoring companies with strong cash flows and pricing power, businesses that can operate independently of external financing pressures in a higher rate environment. Cyclicals also saw renewed interest, especially those tied to domestic demand and manufacturing. The combination of lower energy costs and improving activity creates a more supportive environment for these sectors. In simple terms, institutions are repositioning for a world where growth holds up and the worst-case geopolitical scenario doesn't materialize. But this repositioning also brings a layer of fragility. One risk that may not be fully priced is the physical reality behind the energy market. While sentiment has improved, supply chains are not yet fully normalized. If disruptions persist longer than expected, production constraints could emerge, particularly if storage capacity becomes a bottleneck. That kind of constraint wouldn't show up immediately in headlines, but it could have delayed and more persistent effects on supply. There's also a broader structural question around inflation. Even as oil falls, gold continues to rise, and that combination is unusual. It suggests that investors are not fully convinced inflation risks have disappeared. Instead, they may be hedging against a more complex environment, one where growth remains resilient but inflation pressures don't fully fade. And that leads to the bigger macro signal. Today's market reaction suggests that investors are moving away from a pure crisis mindset toward a more balanced view of the environment. Growth is not collapsing. Policy is not tightening further. Geopolitical risks may be easing, at least temporarily. But at the same time, inflation remains a constraint, and the system is still sensitive to shocks. So rather than a clean regime shift, what we're seeing is a recalibration of probabilities. The market is pricing a better outcome, but not a risk-free one. An interesting debate among investors right now is whether this repositioning is happening too quickly. Is the market correctly anticipating a stabilization in both geopolitics and growth, or is it underestimating how fragile those assumptions still are? I'd be curious how you see this developing. Feel free to share your perspective. Looking ahead, the next phase of the market will likely depend on a few key variables. First, confirmation of geopolitical progress. It's one thing to signal de-escalation, it's another to see sustained normalization in energy flows. Second, upcoming economic data. If growth continues to surprise on the upside, it could reinforce the current rotation, but any signs of weakness would quickly challenge it. And third, central bank communication. Markets are comfortable with a patient Fed, but that confidence depends on inflation remaining contained. So when you put these together, easing geopolitical risk, resilient economic data, and a steady central bank, you get a shift in the baseline narrative, from fear of disruption toward cautious optimism about stability. The broader takeaway from today's market reaction is that investors are beginning to price a more stable environment, but that stability is still conditional. Markets are moving forward, but they're doing so on assumptions that still need to be confirmed. But markets rarely move on a single narrative, so I'd be curious how you interpret today's signals. If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.